Hello, friends. Let's talk today about the fall of First Republic Bank and its repercussions on the global financial system. Now, when the First Republic Bank fell, it indicates a deepening financial crisis in US that will have ramifications across the financial system. But as far as Federal Reserve is concerned, one good point is, though they have again raised the interest rates by about 25 basis points, taking the funds interest rates to in the range of 4.75 to 5% now, a very steep hike in the last 13 months, and that led to the fall in yields. And any fall in yields will cause notional loss to the portfolio of banks held in investment portfolio, and that too which were acquired when the interest rates were very low. So as far as the First Republic Bank is concerned, it is also a very good bank, opened in 1985, and it has been running very well for the last about 38 years. And when we look at its business model, it has been providing mortgage loans at a very competitive rates to very high net worth industries, and their target group was to acquire business from high net worth individuals and also to lend to such kind of mortgage loans to the high net worth individuals. So their business is more of a wholesale type of banking, as I perceive, than the kind of retail businesses that of course they also conduct retail business, but when we see the proportionality of business, then the tilt is more towards the wholesale kind of lending operations that they have. So when like any other like SVB Bank or Signature Bank, the portfolio has eroded on account of fall in the yields and the inverted yield curve, and that caused there has been one common phenomenon in this kind of a stressed situation, when central banks raise the interest rates on one side and they absorb the excess liquidity on the other side, making the money very costly. So the near money is very costly, and any asset liability mismatches that are part of the banking operations, because the asset liability mismatches are a common phenomenon, and there is a what we call a risk appetite which is set by the banks, through which they make money by having the mismatches. We cannot have a situation where there will be no mismatch in any of the structural liquidity time buckets that the central banks prescribe. So there will be commonly the asset liability mismatches, and when there is a dearth of resources to the constituents of the banks, like the banks customers are also stressed because of the rise in the interest rates and a rise in the borrowing costs, so they definitely fall back on the deposits that they have kept in the banks when the interest rates were low, and that led to the sudden outflow of funds from the banks. So there is a pressure on the deposits, there is no inflow of deposits, and the existing deposits are being withdrawn by many of the constituents, as a result of which there will be wider ALM mismatches, and to meet the wider ALM mismatches, banks will have to borrow from the markets, which will be very costly, and which may sometimes result in clogging of funds, that is, they are not able to meet their commitments. That is what has happened in the case of SVB Bank as well, and the First Republic Bank now. So that led to the collapse of the banking system, because if all the depositors, they want their money back, I think the institution will face a lot of difficulty in procuring the kind of funds that are required, and the banks cannot also tap markets, capital markets, because the capital markets are also stressed out because of the rise in the interest rates, and there is a change in the strategies of the individual constituents of the banks who bank with the banks and who are the customers of the banks, they are also stressed out. So they draw more money from the banking system, and when they pull the money from the banking system, both for their businesses as well for tax obligations and other requirements, business requirements, then there is an overall stress on the financial system. And in normal times, these kind of stresses can be managed by the individual banks by borrowing from the markets or by rejigging their portfolio, and there will be some even flow of funds into the banking system. But in this case, this is the third bank that fell, though the Silvergate Bank has gone for a voluntary liquidation system. So now even when we look at the First Republic Bank, the peculiarity is many of their constituents are high net worth individuals, and the level of deposit insurance is 250,000. So the fear is many of their customers may not be covered by the deposit insurance of the US financial system. So that brings one kind of risk. And now the JP Morgan has agreed to take over the First Republic Bank, and all the 84 or 85 branches of First Republic Bank will be opening as JP Morgan branches in US. That is a good going, but they have some kind of a fine print as far as in the process of taking over the assets and liabilities of First Republic Bank, that the single individual exposure that they have in their business mix, I think there are certain kinds of reservations as far as JP Morgan Bank is concerned. But nevertheless, the most of the depositors will be protected. But the kind of stress that is created because of this kind of repeated failure of the banks, I think the banks will have to take a cue from the ongoing stress. But one final point I would like to, before we end the conversation, that Federal Reserve has given some kind of an indication that if there is a further fall in the inflation in US, then this may be the last hike in the interest rates. But of course, that comes with a clause that it all depends on how the inflation trajectory will work out in future, and how the data points come up, and how the macroeconomic dimensions work their way. So depending on that, the forward guidance of interest rates and the interest rate trajectory will work out. But nevertheless, one good point is there is some kind of a sentiments which has been expressed by the Federal Reserve that they may opt for a pause, and then maybe after 2024 or in the later part of 2023, they may go for lowering the interest rates. So the trajectory of going up and then staying there and then coming down, I think we can look forward for a better times to come as far as the financial system is concerned. So let's meet in the next discussion forum, in the next YouTube channel. If you have not subscribed to this channel, please do subscribe and share with your friends and associates, because the very purpose of these discussions is to bring in one place the macroeconomic and financial developments that do take place in the economy. So thank you very much for being with us, and we will go forward in discussing further as we move ahead. Thank you very much.